And finally tonight, NewsHour economics correspondent Paul Solomon looks at the troubles facing the commercial real estate market as part of his ongoing reporting series, Making Sense of Financial News.
There's so many vacancies of retail spaces, former restaurants, other shops.
Real estate analyst Bob White playing Virgil to our Dante on a guided tour of what some fear might become the hellish state of Manhattan commercial real estate. The hotels and stores, apartment and office buildings that raise the possibility of a next mortgage meltdown. First stop, Worldwide Plaza. 1.6 million square feet of prime midtown office space developed by one Harry Macklowe.
In early 2007, it sold as part of a package of buildings, and this building was priced around $1.7 billion.
And what was the deal?
This organization bought this property and 6 others for a package deal for around $7 billion.
And how much did he put in?
Well, that's what's amazing. Only $50 million reportedly was the equity component of that deal. The rest was a combination of a first mortgage and a second mortgage.
So $50 million on $7 billion, that's less than 1% down.
But at the time, the market was full of such optimism that rents would keep increasing and the office buildings would stay fully leased. The economy was still growing. Banks had a lot of money to lend, and there were many investors that also wanted to be in commercial real estate.
But not anymore. Great recession, sky-high unemployment, a glut of office space, so rents fell, building values too. Meanwhile, the short-term one-year mortgage for Worldwide Plaza came due. Owner can't refinance, the lenders take over. Resale price?
Just traded about a month ago for just under $600 million.
Wait, it sold 2 years ago for $1.7 billion and now for $600 million?
Yes, in very rough numbers. That's a significant discount, and that is...
Significant discount? Yeah, that's 2/3 of the price.
Exactly. The overall market is down approximately 35% from the peak. This traded at a more significant discount because it is 50% vacant. And in today's market, vacant space is worth very little.
A block away, a further sign of trouble.
This is a development site. There was a grand tower planned for it, but like many other projects across the country, it's been delayed right now.
Unable to find tenants to fill the planned $1 billion skyscraper, the developer suspended construction. Workers protecting the foundation, hoping to build another day.
How many sites like this are there in New York?
There are over 300 in New York alone, and of course across the country, every city has lots like this that were planned grand developments that will never get off the ground. When we look at development sites down in, say, Florida and California, they're trading at 10, 15 cents on the dollar.
Just around the corner, yet another ill omen. Feeble consumer spending has spurred a surge in hotel and retail mortgage defaults. The Dream Hotel is past due for $100 million.
Well, it looks like a prospering property. I mean, the restaurant's open, the hotel is in operation.
There's a lot of activity. It looks successful. It's just not making the same kind of revenue that they projected that they would be making at this point. Therefore, the loan's in default because the loan was also made based on those very optimistic assumptions.
So basically properties like this just sold for too much money.
They sold or were financed for too much, not unlike housing, where the buyers would think that their incomes would keep rising, and that didn't happen, and therefore they got into trouble. It's very similar in the commercial sector as well.
And White's data suggests that the $3.5 trillion in outstanding commercial real estate debt could be what some fear. The other shoe about to drop.
We've tracked, at this point, $135 billion of commercial mortgages in the U.S. that we know are in default or in bankruptcy. Certainly, there's probably more that we don't even know about, and many that are on the cusp. That number is growing by about $5 billion a month. It hasn't slowed. There have been estimates of $800 billion to $1 trillion of commercial mortgage defaults over the next several years if we don't find a solution to our current troubles.
So then are gloomsters right in thinking a new default crisis is inevitable?
Many of the banks have been very willing to extend loans and delay the problem. And hopefully by extending, the market will rebound before they actually have to realize those losses.
Hopefully. But the latest surprising rise in unemployment bodes ill for both consumer spending and business investment going forward. And thus you can see why the commercial real estate market could be another harbinger of continued tough times.
On our website, newshour.pbs.org, you can also tour the Boston area with a labor economist and learn how the recession has affected retailers there.